Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Andrew Beer and Tom Wrobel, who is a director within the Capital Consulting and Capital Introductions team at Prime Services and Clearing at SocGen, as well as myself, of course, Niels Kostrup Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Andrew, Tom, it's great to have you both on the podcast this week. How are you keeping? How was your holidays? What about you, Andrew?
Holidays were wonderful, thank you. Except I'm struggling with the tail end of a cough, so you're going to hear a very raspy version of me today. But again, it's always a pleasure to be here.
Absolutely. How about you, Tom? How are you doing?
Very well, thanks, Neil. Delighted to be on. A long-time listener, but a first-time contributor. So thank you for having me on.
It's so weird. I mean, obviously, we've crossed paths for many, many years, and we should have had you on a long time ago. So we're going to make up for that today and hopefully in the future as well. You know, I think that this conversation, we're kicking off a new year. I think we're going to be touching on a lot of really important topics when it comes to the CTA industry, but also at a very important time, actually. And you both bring some unique insights that I'm very excited to share with our audience. So I have been looking forward to this quite a lot. Now, before we kick off with all the CTA-focused stuff, I'm always curious to what you have been keeping an eye on, anything that's been on your radar. So I'll let you go first, Andrew, on this. Anything that you've been pondering over the holidays?
Well, I mean, to me, the thing that I'm watching probably most closely outside of the space is just what's going on in the political sphere. And in the U.S., I find it absolutely fascinating how the Trump administration is bringing back a sense of animal spirits back into the U.S. And again, my mother's side of family has been involved in. They're always like business people taking roles in the government, but it was always in this very kind of austere, noblesse oblige kind of way. They're very conservative people. This was their duty. They were serving, that kind of thing. What you have now with Trump, and it used to be a very, very reactionary movement, but it's now been embraced by people who are economic glass breakers. People who have done extraordinary wealth creation on their own, and so they're bringing to. I mean, the people that he's appointing are these brash billionaires, and who are untethered by what we normally think of senses of propriety and decorum and things like that. And I'm so utterly fascinated to see how this plays out in the U.S. because there is a sense that the Trump movement has now been almost taken over by these people who are not reactionary, trying to take America back to what it was 30 years ago, but are thinking about where they can take America over the next 20 years. And it's going to be entertaining, let's say, to watch how how all the skirmishes play out.
Absolutely. Tom, I know UK politics is also quite colorful at the moment. I'm sure that's not what's been on your radar the last few weeks.
I think Andrew's right. I think we've just come out of one of the most interesting years in terms of elections and geopolitics, and I think the how that plays out is going to be really, really interesting. Are we going to have a period of calm, or are we going to have the continuation of a lot of interesting moves on interest rates, policy, and potentially from an investing side, we're going to be in the scenario of one of the most interesting macro environments that we've ever seen, with all sorts of things moving around after a period of continued calm where rates were at all-time lows for an unbelievable period of time. We're now, the stage is set ready to see what happens in 2025.
Yeah. I mean, for my part, because I haven't had to record anything the last couple of weeks, I've had a little bit more time to think about other things. A few things that caught my eye that maybe is relevant for also our conversation today. The first of all, I do think it's interesting to see how after 100 basis points cut by the Fed, that long-term rates have really moved up. And it hasn't been a great year for fixed income, certainly not long maturity fixed income. I think the TLT is down at like 8% or so this in 2024. And so in that light, again, you think about trend following or CTAs in a 60-40 portfolio context. And I think that's certainly worth noticing, because we know so many people like the bonds to be the protection of their portfolio. The other thing that came across was something yesterday I just saw quickly. It's an article, and I think it's from related to a demographer called Mark McGrindle, who coined the phrase, I think, Gen Z, and there's another generational term that he used. But he's basically saying that all babies born now from this year on, and then the next 15 years or so, will be the generation beta. So maybe they'll only be used to having these tracker products in their portfolio and so on and so forth. I don't know. We'll see. It's not a completely crazy thought when you think about what's been happening in our investment world in terms of product launches. And then the other thing that came to mind was, just as the year was ending, the headlines that we've now had the best 2-year calendar year performance by the S&P since 1988. I mean, clearly it has been a very easy period to be a long-only equity investor. And that also means it has been very difficult to be anything other than that, including a CTA, for example. And then finally, that coincides, of course, with the CBOE SKU index hitting a new all-time high in December, meaning that's a lot of people out there might be worried in terms of some kind of markets heading south in the coming year. So those were mine. Feel free to comment. Yeah, Andrew.
Yeah. So actually, the point about bonds is I've been waiting since the end of 2022 for people to start to realize that. So what happens is when people have a favorite asset class, which bonds were for 20 years, and it starts to do badly, everybody's first instinct is, how do you defend it? How do you make an argument that it's going to come back? Because wealth managers in particular, and lots of institutions, really don't have a playbook for if bonds aren't working. So in the absence of having a playbook, they kind of hope it's going to recover. And so beginning of 2023, it was the year of the bond, right? This is the year the bond's going to come back. Then 2024 was the year of the bond. It hasn't happened now. And so we're now halfway through the 2020s, right? And we've had 5 years in the 2020s, and bonds have done nothing. Zero Sharpe ratio over that period of time. So to me, one of the triggering moments just in the media is some guy at the Wall Street Journal wrote an article basically saying, like, bonds really aren't working anymore. And so that's a critical component for growing the pie in things like managed futures, because the argument was always, why would I do that when I can do bonds? And it takes people a long time. But I think this, unless economic growth collapses and bonds do incredibly well over the next 6 months, you're going to start to see this kind of wrenching, grinding change where people say, maybe it's not 60-40 moving to 50-30-20 because equities keep working. Maybe it's 60-40 moving to 60-20-20. Maybe that's where you take more of the money from. So I completely agree. It's absolutely fascinating. And people don't talk about it. They talk about equities going up, not the fact that, bonds have been struggling the way they have.
I think it's something that we hear a lot in the discussions we have with allocators and investors, and especially in the US, where there's a lot of forward thinking about what is the portfolio that's going to be robust and protect us going to look like over the next 5-10 years. And there's big focus on building these robust portfolios. We hosted an event last year where that was specifically the focus of a panel. And they are looking more and more to alternative strategies to fill maybe the void left by bonds, I don't know. Or as you say, adding it as an allocation to complement that bond portfolio. But it's specifically looking for things that are going to be diversifiers, non-correlated, and adding a little bit of that performance when maybe the equity side does slow down. And I think that's probably one of the biggest concerns that we hear from investors is next year, equities may not be growing at the same rate. So where are we going to be looking in our portfolios to get those levels of return?
Actually, the average 12-month return after a great 2 calendar year performance like we've just seen is not very impressive. It's pretty flat, actually. So who knows, maybe that will turn out to be true again. Now, before we dive into all the details, let me mention, first of all, that my own trend barometer finished at 59 at the end of the year, and it has been moving higher at the beginning of 2025. So maybe that's a good sign for the year, who knows? But of course, and especially in your presence, Tom, we need to go through the various indices which are dominated by the SocGen indices, of course. So the beta 50 finished the month of December up 1.22 and up 4.44 for the year. SocGen CTA up 1.16, up 2.24 for the year. SocGen Trend up 1.4% in December, up 2.56% for the year, and 0.52% up for December in the SocGen Short-Term Traders Index, and up 15 basis points for the year. I'm going to include one more this time around, which I never do, and that's the Bridge Alternatives Index, which is 5 flat fee trend following funds. They were up 0.92% in December, and it's up 0.55% in 2024, and that will be relevant for one of the talking points later in our conversation today. In the traditional world, MSCI World was down 2.69% in December, but still finished up 17% for the year. The S&P US Aggregate Bond Index was down 1.41% in December, but up 1.82% for the year. And the S&P 500 total return down 2.38% in December, up 25.02% for the year 2024. All right, so I thought we could start our conversation today, maybe with you, Tom, because we are going to talk a little bit about, maybe a lot actually, about indices, obviously from your perspective, from Andrew's perspective. So why don't you spend a few minutes to talk a little bit about each of them, maybe why they were conceived, the way they're conceived or structured. And then also there is a new SGI CTA Managed Futures Index, but it sits in a different part of SocGen, so maybe we need to explain that a little bit. And so, yeah, I'll let you lead the way.
Thanks. So I think your trend barometer is probably in line with how we've seen performance play out recently as well. I think 2024 was an interesting period in Q1 and then a really difficult period through Q2 and Q3, coming back with stronger performance in Q4. So we're definitely seeing performance coming back in the trend following space. And hopefully that's going to persist through into 2025. But you mentioned the various indices, and maybe it's worth setting the record straight on the sort of differences between them exactly. So we've been running the ESG-CTA index for 24 years. It's coming into its 25th year now. And that is a live index with daily data, which represents the largest CTAs in the industry. We go through an annual reselection process where we pick and rank the largest CTAs. The two main restrictions we have is that the constituents have to be open to new investment, so they cannot be closed, and they also have to trade an appropriate strategy that is diversified. And in that strategy, the main P&L driver has to be futures and FX trading, because really CTA is a bit of a misnomer. It's a regulatory term that doesn't necessarily mean that much. It's obviously CTA, CPO are these historical terms for groups that run CTA portfolios. But really, people have come to think of CTA with that instant association with trend following. But for us, we run the SG-CTA index as a sort of more open, broad brush approach to futures trading. It includes trend following and non-trend following strategies. And approximately half the constituents, so the top 20, half of those are non-trend. So we get this very interesting mixture of other strategies, for example, quantitative macro, which is maybe a more fundamentally driven strategy, shorter term trading, and we define short term as anything less than about 10 days average hold, so a 2-week period, as well as maybe commodity only strategies, or just sort of other technical strategies that don't fit into the trend following subset. I'm thinking of groups like Fort, where they run really interesting strategies all based on technical price-based data, but it's not trend following explicitly. And so we've just announced and done the rebalance for the SG-CTA index and the trend and short-term indices. It's going to be very interesting that we're seeing very little turnover in constituents this year. We're going to have no changes to the SG-CTA index, as well as no changes to the SG trend index, which is probably the first time we've had no turnover for quite a long time. And we're going to see, I think, 2 changes to the short-term traders index where we have historically seen more changes, but that is because that space is a more difficult space. And you were saying the performance has come out pretty flat for the last year. We tend to see a lot of performance dispersion in the short-term space. And so often the groups struggle to persist with performance for many years in a row, and it can make asset raising in that space a lot harder. I think it's dominated by 2 or 3 groups that have been there for a long time and do very, very well at it. And so that's the sort of the SG Prime, which sits on the agency side of the business. Those are indices which are sort of the barometer for CTA performance. And then we've got the new product, which is the SGI, so the SG index business, which is SGI CTA Managed Futures Index. And this is run by the DBI strategy. And it's really a product offered by our structuring team to provide access for investors to access DBI strategy. And for us, it's subtly different. It's definitely different from the indices. And I think it is an interesting product. But for us, it's kind of more of a single manager rather than an index. It's the index term is a nomenclature thing in the way our SG index team operate. And so it'd be interesting to hear from Andrew about the engine that powers that and the replication that goes on, because I think it is an interesting way for new investors to access the CTA space.
Yeah, because obviously when you refer to DBI, that is of course Andrew's firm, and we know it as DBMF, of course, the US ETF. And I was also, when you mentioned the word index, I was also, and we talked a little bit about this before we press record, I was also under the impression that you had to have more than one constituents to be an index, but Andrew corrected me and that you don't have to have that. So that's perfectly fine. But yeah, I mean, what I'm curious about also is when you create an index, maybe different from an ETF, do you have to make any disclosures, Andrew, about how it works, or can it still be completely proprietary in terms of that?
So again, let's sort of differentiate between 2 different kinds of indices. One kind of index, so every index is based upon a mechanical strategy where it's supposed to be predictable. What I'm doing today is what I'm doing in 10 years and what I'm doing in 20 years. And what Tom, and by the way, when we first started looking at replicating the managed future space, the obvious choice was the SocGen CTA index. That is the industry standard. It is head and shoulders, we think, above any other index out there. But the whole idea of an index is you're trying to create something around a mechanical strategy. The S&P 500 is an index, but it rebalances. And there is a methodology that they employ to rebalance it. Sometimes the methodology is purely mechanical. Sometimes there's an element of judgment involved in it. In the case of, I think what Tom is describing in this index is they have certain criteria, but there are also judgment calls that they'll make in terms of whether a particular manager fits into their criteria or not as well. But the point is that the index, you're supposed to be able to look at it and say, if I was looking at this space in 2015, is this what I would, how would I have thought about this space? Is this representative of the overall space, et cetera? So every index has its own mandate. When you move to the structured products world, or my argument is that a hedge fund index has limited applicability outside of that $300 billion of institutional investors and family offices that invest directly in hedge funds, because in the wealth management space, most people cannot invest in hedge funds. So to use an index of hedge funds to decide whether you find the space attractive or not, there's a big gap between the data that you're using and how they would think about whether and implementing it from a portfolio perspective. So the whole idea of replication was trying to create an approximation, a clearly an imperfect approximation of what the hedge funds are doing, but to do it in a way that was mechanical, but also investable, in that you don't have to invest with another manager to do it. In our case, we obviously have a few investment products that do it, but rather to have a portfolio of instruments give you exposure to it, so you can say, if I like that return stream, I can invest in it directly. Then now, when we launched the replication-based strategies back in 2015, 2016, they were in essence viewed as active strategies at the time, because we had to decide how we wanted to build the models, how we wanted to implement it, et cetera. 8.5 years later, or 9 years later, depending upon our two configurations of the strategy, we've essentially stayed with that same mechanical weekly approach that we've done, which looks and feels very index-like. And so to us, the next evolution was for a wealth manager for whom a hedge fund index has limited applicability, let's try to give them a tool where they can look at the space from what we would call, investable is a little bit of a loaded term, because you're not actually investing in hedge funds. We're not even a CTA, right? I mean, we are a CTA technically, but we're not building our own trend following models. But the idea is to give something that is actionable for them, where they can say, what would my experience have been like if I had this in my portfolio over the past 20 years?
Then are you not building trend following models?
We have trend following models that we run internally, but we don't invest in them. We just use them as risk tools to understand what is working, or what is working better or worse on the replication side. The way our approach to replication works is, on Monday, we're looking at the very recent reported data of just the hedge fund index. And the research conclusion that we drew in 2015 and then ultimately in 2016 was that over a 1-week interval, over a very, very short-term period, on Monday afternoon, we can estimate the broad factor exposures. So using only 10 deep liquid markets, S&P 500, 10-year Treasury, et cetera, with enough accuracy that by the next week, on average, will be pretty close to what the index is doing. With the added hook that when I spoke to allocators back then, there was often a big difference between what some people would pay versus what other people would pay. So we said, all right, instead of trying to go after the reported numbers, which you can answer this better than I can about tend to be headline fees, the idea was, could we come up with some sort of an estimate of the pre-fee, pre-trading cost returns, aim for that, and then see how we do over the course of next week. So what we're doing is not at all based on our own trend following models. Rather, it's based on a factor decomposition of an index of hedge funds, which you can invest in if you're an institution, but not a wealth manager.
I don't know, obviously, kind of the side-by-side evolution between the returns you're generating, Andrew, and the index itself. But from memory, when I've looked at it, in the past, there certainly were calendar months where there were huge differences in the reported return. And so how do you think about replication? Because maybe I kind of misunderstood the term in the sense that I thought, well, we want to have the same monthly returns as the index. But that's probably not exactly what you're getting, but you are over time. So how should people expect it to be different, and how should they expect it to be alike, if you know what I mean?
Sure. So what we're doing is a vast simplification, which is going to have a lot of noise, we would say, right? So if the cocoa market is ripping, we're not participating in the cocoa market, right? We're participating in other things. We may pick up some of it indirectly. The question was, what are your alternatives? Right? You mentioned the bridge index. So the bridge index is interesting. It's 5 managers. You look at the performance of that thing over time, and it's statistically incredibly close to the SocGen CTA index with 20 managers. And I believe all of the 5 managers are in the SocGen CTA index, right? That is the standard playbook for an institutional investor in the space. They want exposure to the space. They love the SocGen CTA index, hedge fund index, as a measure of, they love the statistical benefits of it. But when they look at each individual manager, there is far greater tracking error than what we would do. Sometimes you have, a manager who underperforms by 20% over a period of time. And so they tend to combine managers, and you get diversification very quickly. You don't need 18 of the 20. You can get there often with 2, 3, or 4 managers. So a typical portfolio is going to get diversification to reduce single manager risk, to raise your correlation to the index, hopefully to, somewhere in the 80%. And if you pick the right guys, you'll outperform by a few hundred basis points over time, right? That's the standard institutional allocator playbook. And by the way, if you're a big allocator and you can compress people on fees, you'll tend to structurally outperform as well. So replication is philosophically similar to that. And we're saying, well, you already have diversification built into the index of 20 managers, but the approximation is going to be is going to be much noisier. So over that 1 week period of time, because of the differences in fees and expenses, we'll tend to outperform 53 or 54% of the time, but it's noisy. We might be, on average, will be 60 basis points above or 60 basis points below. Over the course of a month, the tracking error can be quite wide. But like anything where you have like the house in poker, or or anything where you have a repeated process where you have a slight edge, it builds up over time. So the idea is that, the tracking error is high relative to the hedge fund index, as you'd expect, but having the tailwind of consistent outperformance means that over the course of a year, you might outperform 80% of the time, the index. Over the course of 3 years, you get into the 90s. And so what it was really meant, but unlike investing in hedge funds, you can do it in an ETF in the US and disclose all your positions every day. So it was really an investment tool that was saying, we love the space, we love the category, but within the constraints of, we need liquidity, we need daily liquidity, we need position level transparency. We want to be able to do this as cheaply and efficiently as we can to try to expand the pie. What's the best way we could get there? And this is what we came up with. Maybe someone will come up with a better idea tomorrow. Yeah.
For sure. So let me stay on that and involve you a little bit here. And I'm jumping around a little bit in our planned agenda here, guys. I hope you appreciate that. You mentioned fees, and I remember distinctly that the Bridge Alternative Index came up and saying, "Oh, this is a great way to get exposure to trend following at low fees because it had to be flat fees funds only." Can you remind us, Tom, what are the average fees in the indices that you have today? I'm just curious about that.
Yeah, I worked this out for you in advance. So with the new constituents that we're going live with, although there's obviously no change in the CTA index, we're going to see an average fee in the SG-CTA index of 1.3% management fee and 13.9% performance fee. And then the corresponding levels in the SG trend index is 1.1% management and 11% performance fee.
Yeah, because, and this is what's interesting to me, just as a little anecdote, and that is, so I took a look, because now we have 9 years of performance data, I think, from the Bridge Alternatives Index, and of course we have a longer history from the SocGen Trend Index, and it actually turns out that the promise of low flat fees would produce better performance. It actually didn't. The performance of the SG Trend Index is marginally better over that 9-year period, and the Bridge Alternative has produced 50% higher drawdowns.
Well, this is going to be one of the questions I was going to ask Andrew. Is you mentioned the cocoa example. That was obviously a market which contributed a lot of positive P&L to the CTA space in 2024, but it's something that, if I'm correct, you don't trade. So how do you account for the missing of individual markets? And do you still think you create the performance characteristics that are so attractive to institutional investors when they build their portfolio and they run it through their models with the data from the various kind of indices, such as the Bridge or the SGE Trend Index? Because it's something that we've tried, and we had a research project 10 plus years ago where we created a similar kind of tracker performance attribution called the trend indicator. And it's something which is a very, very useful tool that allows us to see individual market positioning, likelihood of reversals in terms of changing from a long to a short position, how a trend is developing, and also the P&L that we're deriving. But although we've managed to create this long-term performance and correlation profile, which looks very similar, as Neil says, the drawdown and often the risk that we are taking is very, very different from the real life CTAs that we see in the SG Trend or the SG CTA index. And it's not something that I think people would be that interested in investing in. Okay. And it's not investable. Full disclosure.
Yeah. So I think I mean the answers of the last question first is, what are people looking for when they're investing in this space? Generally, they're looking for low correlation to stocks and bonds, low beta equities, alpha generation, performance during crises. Somebody made sort of a pejorative comparison of replication to buying a cheap Louis Vuitton bag on Fifth Avenue. And, when you really want the real Louis Vuitton bag. And I said, actually, no, the right analogy is a Tesla. It's that, you have a 200, I'm not a car guy. So, you've got 200 parts, let's say in an ICE engine, and you got like 20 in an EV engine. And funny is, I've got a 3-year-old who loves cars. So I'll take him to car shows and they pop the trunks on all these cars, and they're showing cars in, 1950s, 1980s, 2023. And everyone loves to look at the engines. Half the people show up in Teslas, right? And it's what are you trying to achieve? And so to us, we wouldn't be replicating the way that we did if we didn't think we were capturing those diversification benefits. And if you look at the correlation of replication over time, it's not perfect, but the correlation ends up being about 0.9 when you do it with a full factor set. When you limit the factor set, you're kind of in the 0.8-ish range. And you tend to have the same beta, same correlation, and same crisis alpha. The difference is that, in a period like the long winter in the late 2010s, when you have a convergence of three things that made the space a very difficult space, right? You had a market environment that was very anti-trend between the Fed put and everything else. You had cash earning zero, right? So basically your nominal driver of returns, your base case of returns was zero. And you had a fairly high fee structure in that. And so you take the combination of those three overall, and you end up with basically a period of zero net returns over multiple years. Now, one of the benefits of replication is that it is just really efficient. People call it a structural source of alpha. If you can capture those same statistical benefits, but with 10 or 20 basis points a year of trading costs, with a handful of instruments, and if we're willing to charge lower fees to do that, then what ends up happening is, when you look at the long-term returns of the SocGen CT index relative to cash, it outperforms cash about 60% of the time on a rolling 1-year basis. But you start to eliminate costs and expenses on trading, and then you quickly get up into the 80% or more outperform on a 1-year basis. So it's all about just trying to create something that gets you to the same economic conclusion, with clearly an intellectual leap of faith that we're not doing what the underlying hedge funds are doing to get to that. Rather, we are, piggybacking, replicating, whatever term you want to use, to try to understand what they're seeing, what information they're getting that's causing them to change their portfolios. And I'll pause for a second, then I want to answer the question about the idiosyncratic positions, because I think that's an interesting one as well. The SocGen CT index are large CTAs. And usually what you have is, we trade 10 markets. they'll trade the same 10 markets, and then they'll trade another anywhere between 40, 50, 100, 200, whatever markets outside of that. As your portfolio expands and as the liquidity of those positions goes down, it is natural for firms to limit the sizes of those positions. And so if you take a market like cocoa, earlier this year when cocoa was ripping, again, and this is rudimentary Andrew calculations. Again, Tom, you're going to have a much more sophisticated way of looking at this. But it looked to me like there was about $5 or $6 billion that was being made in cocoa over about a 2 or 3 month period earlier in the year. And if I take that and I say, all right, let's say half of that is CTAs, and there's 300 billion in CTA hedge fund assets that we can see, plus synthetic products on top of that, plus internally run programs, et cetera. You're not talking about, AQR and ManAHL and all these other firms saying our year was made by cocoa, right? It's going to clearly incrementally add. Now, there are periods where replication will underperform, but it's because there are multiple things that are working at the same time. January and February of 2023, we're running our own trend following models, and we're like, yeah, we're missing the Mexican peso, front end of the Canadian interest rate curve. Look at, Neil is having a field day, in softs and commodities and other things that we're not getting direct exposure to. So statistically, there will be times when all these other things that are trading, a whole bunch of them are going up for them. I think there are periods this year where a whole bunch of them were going against people and we weren't getting hit in the same way. But most of the time, some will be doing well, some will not be doing well, and they tend to cancel each other out.
Right. It's just, if we look at the main performance drivers for performance over the year, it's probably, commodities is that standout sector, which was contributing, I would say, for most of the trend followers, a large part of their P&L. So the top 1, 2, 3, 4, 5, 6 commodity markets in our trend indicator contributed a significant amount of P&L to the theoretical portfolio. And it's just interesting if those are omitted, is the client getting the similar profile that they're hopefully expecting, is the question.
The paradigm that you're saying is if we admit it, we get zero, right? So if we ran a trend,
you get zero on the positive side, yeah.
Well, if we ran a trend following model, right, and so if we did bottom up replication, right, and we did it like some of the firms we talked about, and we said we're going to mechanically decide to invest these markets, but let's get rid of all the commodities. We're going to have a much, much, much bigger impact in that case. When you're doing a 1 week factor replication, one of the statistical conclusions is that it's almost like the metaphor is almost like planets and moons. If oil is moving, so in our standard model, we invest in oil and gold. If oil is moving, it may not matter to the cocoa markets. But if oil is moving in a big way, it's probably pulling other markets along with it. So it's not that we're going to get zero exposure to commodities. We'll get some exposure to it. Now, again, there are these idiosyncratic positions that will do well, but often over short periods of time, there's something bigger going on in the market. There's a bigger wave out there. And these are very, very important crests on that wave. Now, if I were trying to maximize my own P&L in terms of building one of these strategies, like again, remember, I built a commodity business in the early 2000s. And that was based upon these highly, highly asymmetrical payoff profiles. But as an allocator, you can concentrate on those bets. You can make that bet, but you tend to take a lot more risk. You tend to have much higher drawdowns. It's very difficult to model how you would have felt about those bets 15 years ago. So it's not, I think people often think about replication as sort of one or the other. We just think it's an incremental tool that people can look at as they're thinking about how to build a portfolio in this space. And I would say most allocators that I know well who invest with us combine us with other funds precisely because they recognize that we're very open about the things we're not doing. Like in the US, people often combine us with ManAHL's mutual fund. They're much better at short-term inflection points than we'll ever be. They have, if you look at even their ETF in December, their ETF ripped in December. Is great in December again, because they're going to get direct exposure to some of the things that are moving in December that we didn't. So it's really not about, we've always tried to view this as something where we can incrementally add tools to investors, given that people are looking to accomplish different things.
It just seems counterintuitive to your earlier talking about how you're trying to replicate a portfolio and you aren't a single manager strategy, but then to say that a lot of your clients blend you with other single manager strategies in the way of kind of creating a portfolio or an index similar to the way we run the CTA index. And it seems quite counterintuitive to sort of one of the big areas where we've seen kind of innovation and developments in the CTA industries over the last 5-10 years, which is really that focus on execution, being very efficient, and big focus on trading costs, which then allows them to access more and more markets. Because one of the sort of main phrases in the industry is, diversification is the only free lunch. A standalone, a market maybe has a trend following Sharpe ratio of 0.2, 0.3, but if you add more and more assets together, you can increase that Sharpe ratio. And I'm not going to pretend that I don't think many CTAs would say they're achieving a Sharpe north of maybe 0.9. So the only way you're going to get to that point is if you are adding more and more individual idiosyncratic bets, shall we say, as in individual markets.
So the point about the investors. So the investors, I don't think it's an economic decision on their part. I think it's a client communication issue that they know if the day that SVB hits, to be able to say at that point we've got guys who are replicating and they're going to be slow at an inflection point is not the only conversation they want to have. They'd rather say we're blending that with somebody who's going to respond better.
So are you slower in an inflection point?
Sure. Oh yeah.
Okay.
Yeah. And now half the time, right? We like in SVB, when you have an inflection point that then goes on, let's like SVB hits and then, oh my God, the regional banks are going, and then, oh my God, Credit Suisse is going. When it happens like that, a very sharp inflection point, we're going to underperform by few, maybe several hundred basis points after the inflection point. The reason we don't try to model around it is because half the time, the guys with short-term models, it's actually a head fake, right? We remember the SVB. We don't spend time talking about the 7 other head fakes that happened during the course of the year, that wrong-footed short-term models or vol controls, et cetera. So if you look at like SVB, we were slow, but then particularly the shorter-term stuff got wrong-footed about a month later when the markets came back and recovered after they realized that, Credit Suisse was going to be absorbed by UBS. And so, by the end of, say, September or something, the replication had basically caught back up to where it was. So it's back to the point. So, investors make decisions on, and the whole point of doing these indices and these other products is that every investor has their own very, very specific preference function. And the reality is that there is no one-size-fits-all solution. So I think the more I get to know investors in this space, and I know them much more in the wealth management space than I do elsewhere, is really trying to understand how do we bring a product to them that solves whatever issues they have. And I say this very, very openly. I will sit in front of clients who are hedge fund investors, and I'll start the conversation by saying, I highly doubt you're going to be interested in what I'm talking about at the end of an hour. Right? And most of the time I'm right. Said that they do want that relationship with a hedge fund manager to hear about all of the instruments that they're trading, et cetera, et cetera. The guy who's running an ETF-based model portfolio in the US, whether the wheat market is ripping or the cocoa market is ripping, that doesn't really matter in his day-to-day job. What matters is finding a great diversifier that he can put into a portfolio that he doesn't otherwise have access to in a reasonable, predictable way.
I want to pivot our conversation a little bit, but I have a question before I do so. But Tom, maybe you can think a little bit about a brief description of sort of the CTA AUM evolution we've seen, and maybe some of the other points in terms of performance bias, et cetera, et cetera. And then, of course, we also have some really good topics that Andrew had brought along that we're going to be talking about. But I had one question that I was thinking about while you were talking about the new index. And I think you said that one of the important things are when you do an index like what you've done with SG is that your model has been consistent now for a long time, many years. Just out of curiosity, if you decide to change your model next year, 2 years from now, what happens to the index?
So in every index, you have the ability to change it over time, but there's a process you go through. There's a review committee or something to that effect. And you publish the changes and tell everyone who uses the index what those changes were and why you made those changes.
But do you change the historical performance of the day of the index or not? Or do you just, no?
No.
You just, okay.
No.
Okay.
And I think that's one of the, I think this is again where you get into a gray area, right? If you say, we're launching an index today, but every 6 months we're going to change what we do. Again, I mean, index, as we've described, is this very squishy semantic term that means different things to different people. The general idea is it's supposed to be predictable, and predictable means consistent. And we are odd from an investment management perspective is that our goal, right, the best outcome for us is we start to do something on day one and don't change it over 10 years. Like that's very, when you talk to most people in the space, they're talking about, what's my edge next year and how am I going to change it? And, what new things are I going to find? That's why we've always had very much of an index-like ethos in what we do. And that again lines up with the wealth management world. There's a reason index products have taken over a lot of the wealth management world is because it's, people say, how do I decide whether I want to invest in the space? Whether I want to invest in hedge funds, whether I want to invest in private equity. Okay, well, I need 20 years of data. Or in the case of the SocGen CTA index, I need 25 years of data, and I can see would this have made my life better over the past 25 years? In the case of managed futures, yes, it is. Okay, that's the first question. The next question is now how do we get exposure to it? Well, if you go do that bridge index as you described, and by the way, when you're talking about performance, I suspect without knowing that that's before somebody else's fees on that. Maybe it's, in other words, there may be implementation fees that we don't see when you're looking at those numbers. And by the way, I think it's just a managed account platform. So it's not actually a funded product you can invest in. It's rather, you have to have a certain minimums and probably go through leverage and whatever, all sorts of other things. But the challenge is then how do you actually get exposure to it in a way? And the reason people like indices is that you're never wrong. If the S&P 500 goes down, it's an issue with the S&P 500. And so the reason we've gone down this path of wanting to have an index out there is because a wealth manager, you've brought up this issue about tracking error. Okay. We have tracking error relative to the hedge fund index as to be expected. We have virtually no tracking error to the replication-based index.
Because it's your same.
Because it's the same model.
It's circular, right? And but that's the same way an S&P 500 ETF product is a circular product. There's the S&P 500 that is calculated in a certain way. It is not actually all U.S. large cap stocks. It is a representation of U.S. large cap stocks based upon a very specific weighting methodology. And the ETF is designed to give you delta 1 exposure to it. So as a wealth manager, what I'm seeing is people increasingly saying, well, maybe I should just start on day one with a replication-based index because that's actually, if I like it, I can actually do something with that. It could be an ETF or potentially through structured products with SocGen.
Yeah, I mean, I get that. And I don't mean to always sound, when we speak, to be the devil's advocate here. But it's almost like, to me, what if I created an index called the Dun, Capital Index, and then everybody could say, well, I'm investing with Dun, and that's great because they track the index. Well, it's done.
You can, but would you be willing to not change what you do?
Well, this is the thing that actually is an interesting point. Obviously, you're not giving a guarantee that you won't change it, I imagine. But the other thing is, I imagine, and Tom might know something about this, I wonder how much the large managers have actually made huge changes in the last 10 years, because I think a lot of our experience has come in the 20, 30, 40 years prior to that. So I don't see managers making huge changes, frankly, on a year-by-year basis, small tweaks, because I guess also there is not too much or too many ways you can do trend following. I think where we as managers are constantly learning things is probably a little bit on the risk management side. I think we're becoming better risk managers, even though we are probably risk managers as a starting point. So I'm obviously we make small tweaks, completely open about that. I don't think we're making huge differences. So that's one thing. The other thing, just maybe I wanted because I asked Tom about this, because I think this is also an important part when we compare these products. Because this was my suspicion. I think I mentioned this to you, Andrew, a while back. I was thinking, well, maybe indices are a little bit disadvantaged if some of the managers in the index don't report interest income in their return stream, because clearly you're comparing it with a product that has interest income like any other fund. And it did turn out actually that 25% of the managers in the SG-CTA index do not include interest income. So there is a little bit of something at least people should be aware of. But Tom, when you look at managers, trend followers, before we move on to the point I wanted to move on to about the evolution of AUM, which I think has not really moved much in the last many years, but I could be wrong here. But do you think trend followers that you meet with make big changes to models as such, or?
Well, I was going to say it ranges some interesting questions when you talk about an index having a consistent methodology. But if your methodology is to track trend followers, of course you can be making changes under the surface. And I'm sure, Andrew, your principal component analysis is changing the composition of the portfolio, similarly to how a CTA would maybe be changing their sort of allocation of risk and portfolio construction. But also you're tracking an evolving portfolio. You're not tracking a portfolio which is a static portfolio. Every year we change the constituents. Those individual constituents are updating their models as well. So I would argue that your top level objective hasn't changed, but the way you implement it is slowly evolving in a similar way to how a research process might be happening at an individual CTA. And it's really something we see a lot of. If you think, going back again to the areas of innovation, trading and execution is one of them, but the other one is risk management. And Niels, I think you make an interesting point. I don't think CTAs are developing new trend following models. Trends are pretty easy to recognize. It's the implementation of the model, the allocation of risk, the recognition of trends overextending or pulling back that is very, very important. And I'm sure you would have maybe more concern if someone had access to your investment committee and how you were managing risk than maybe if someone saw, okay, you're using a moving average crossover model, because that's pretty much standard off the shelf kind of stuff. And so that kind of focus on risk is the important side. And I think that's where maybe you touched on the depth of drawdowns, that certain low fee products have maybe got different characteristics to the SG-CTA index. There's a big focus on the management of risk and trying to create a profile that investors are going to be interested in and which are going to be delivering the best product for an allocator.
I wanted just to, maybe you can give us a little brief thought on sort of the AUM landscape and how that's evolved from, as I said, from my experience. And I know I think it's Barclay Hedge that I normally look at when I look at AUM. You may have better data than that, but I always see it stuck between sort of 350 and 400 billion.
I think that's right. I think we had great, a big period of growth in the late 2000s, so like in the 2009, 2010, when it got up to 350 billion. And that was sort of correspondingly shown in the assets represented by the SG-CTA index. I think there's that kind of corresponding growth. It's been fairly stable since then. I think it's bounced, as you say, between 300 and 350. Post 2014, there was a small uptick on a record year, but the big growth has really been on the back of knockout performance in 2022, where the performance was very strong, and so assets has kind of organically through that performance, but also on the back of increasing investor interest in the strategy, there's been that corresponding uptick. I think now, when we do the annual rebalance, we get very clean asset data, because asset data can obviously be very self-reported and hard to interpret. but we've seen the cutoff. So that's the kind of the number 20. So how large do you have to be to get into the CTA index has grown quite rapidly. And that's really quite interesting. Back in 2010, to be in the index, you had to be approximately 800 million. That then grew to 1 billion in 2016, and then accelerated quite rapidly to north of 1.5 billion in 2019, and has now reached, what is it going to be for this year? It was 1.82 billion. So it's kind of continuing to grow, and that's where I think we're seeing the growth is in that medium-sized group, especially in the trend following space. I kind of mentioned earlier that trend is 80% of the CTA space, and there's that automatic association of trend following with the CTA world. To be in the SG Trend Index, which is only the top 10 CTAs, the smallest size is $4.8 billion assets under management. And I think that space is the one that's become really, really commoditized. And it's a space where we rarely see new entrants unless they have a very unique feature to what they're doing. Now, that might be, as Andrew's sort of saying, an access vehicle, an access route, which is really interesting. But typically, it's more around maybe a focus on alternative markets, or it's looking at something different. So maybe the employing of sort of machine learning techniques. But I think almost 90% of new start quant, what we would call a CTA, is not necessarily going to be in the trend following space. And it's maybe a slight evolution of the newer groups that we're seeing emerging are operating not as a CTA, but becoming more and more multi-asset quant, almost like a quant multi-strat group, where they're targeting high sharp returns and incorporating models across the whole different variety of approaches, and deploying those not in a pod structure, how a multi-strat would do it, but more as a collegiate research team. And these are groups often that come from a variety of different backgrounds, and they maybe explicitly don't want to be part of a pod shop, like a multi-strat, but they're quite happy to run 1.5-2 billion in assets. And it's a really interesting space. And I think more and more of the CTAs are maybe pivoting into that multi-strat space as well. They want to be able to deploy risk in equities as well as futures. In FX, they want to go more and more short term to extract more interesting returns from markets. And it's something where we as a prime broker and the clearing group are seeing more and more interest with our cross-asset capabilities, especially as we can cross-margin everything in a very, very efficient way.
Could you replicate a pod shop, Andrew?
Like a Millennium? Like those guys? No, absolutely not. Those guys are corruptible. There's sharp ratios of 2.2 or whatever. No, look, the thing about replication is you have to know what you can replicate, right? And I mean, part of the thesis of this discussion, I mean, Niels, you said, look, the industry hasn't changed that much in 10 years, right? And Tom has said that like core trend hasn't changed very much. We're picking up on mostly, I mean, again, it depends on how you define it. We think we're most on medium-term trend, maybe longer-term trend. And the thing is, whether the reason we went this route, because we could have built our own medium-ish term trend models like other people have done, Corey Offstein and, Katie Kaminsky they incorporate their own various models. The reason we did was actually because of a belief in evolution. And, if you go back to 2015, 2016, when we first started looking at the SocGen CTA index, it's a very, very, very different group of guys back then. And I mean, there are some guys who I think are all, who've got like currencies in their names or something. And so our expectation actually was the industry would change more over time. And instead what had happens is it seems to have settled into, there's this kind of core trend, which is going to be a little bit cheaper. It's going to be a little bit more commoditized. There's going to be, sort of more focus on risk controls and other things to avoid the crazy drawdowns. And then there's going to be a lot of focus on other things. And the whole point of doing it with just these kind of 1 week, this very, very short-term model, sort of like the paradox is you're trying to I'm much more comfortable making a 1 week bet in an industry that I think will change over time than I am making then I am locking myself into a particular way of doing trend or a particular way of approaching this space today and expecting it to be right in 10 years. To me, it's absolutely fascinating. And I think when we talk about the AUMs of the space, what I see is a very, very, very loyal and stable constituent of investors, who are sophisticated, who view this as something that brings great value to their portfolio from, a broad diversification perspective. But even though the overall allocation is tiny relative to their portfolios, the typical hedge fund, the typical U.S. pension plan, it has 8% of their portfolio in hedge funds, of which 6% is managed futures or trend. So one of the most valuable things they can put in their portfolio is locked at a 50 basis point allocation, because the people who oversee the hedge fund allocations won't say, let's get rid of equity long short, let's get rid of this, let's get rid of these things that haven't added value in a very, very long time, are very expensive and very difficult to implement. It should be half the hedge fund allocation, just statistically. But the people who make that decision are very wed to the existing portfolios they have, their particular way of looking at things. And that's part of why what we're trying to do outside of that $300 billion is get people to say, this doesn't need to be in a hedge fund strategy. Back in the 1990s, this wasn't in the hedge fund bucket. Back in the 1980s, it wasn't in the hedge fund bucket. It was put into the hedge fund bucket, and that's actually limiting growth of the space. Because this is one of the few hedge funds you can say on a standalone basis, this deserves a place alongside REITs, infrastructure, or whatever, just because the statistical benefits are that strong.
Yeah, I think you're very right. It's definitely a lot of investor pushback on how they view it and can they make a large enough allocation to it. I don't know where it necessarily comes to, whether it's like quantiversion or just the periods that are often seen where it's been difficult to pick a CTA which has delivered consistent returns. I think we do see two interesting developments. One is a more definite uptick in interest in portable alpha solutions. So moving from a model portfolio of sort of 60-40 or 60-20-20, or I don't know what the small 5% allocation to CTAs, where they can actually overlay the CTA or the alternatives allocation on top of their equity portfolio and achieve a 60-40-20. That definitely seems to have been an uptick in interest, and something which is very, very well suited to the CTA industry. Operating on margin, these strategies are relatively easy and cheap to implement. And the second one is really aligning the expectations of the investor of how do they put the CTA's objective in their portfolio. And I think it goes back to what you were saying. There's this misalignment of expectations. The CTA is meant to be this non-correlated diversifier, but paid on an absolute return. But they still, fundamentally in their mind, if equities are up 25%, and as we saw this year, CTAs were only up 2%, that isn't objective achieved. That is objective missed because the CTA is underperformed. But that goes against the original objective of why they added the CTA to the portfolio. So CTAs are constantly criticized for doing one or other of the things wrong. Either they have too much correlation to equities because they are participating in equity trends, or they've underperformed but been very non-correlated because they weren't allowed to participate in equity trends. And it's a really difficult question to get the result.
Now let's pivot to Andrews as we start to slowly wrap up, because that is some interesting things you brought along, some American pop culture reference as well. So let's dive into it.
Well, so I mean, back to Tom's point. I mean, I think one of the problems that I run into with allocators all the time is they see the statistical benefits of the space, but it doesn't fit into their view of the world. And I really think it's a narrative issue. Right? I think that, and I think part of the problem is when you go back to who were the original trend following guys. I had this great discussion yesterday with a guy who was one of the original hedge fund allocators to the space. I think he may have seeded Winton and I think he may have been an early investor in Aspect. I mean, he was there in the very beginning. And he said, even from the very beginning, hedge fund guys, the people who were making allocation decisions, they wanted to sit across the table and hear, Alan Howard talk about his view of the world, or Julian Robertson talk about this stock or that stock. It was very different. And the ethos of trend following was, well, we look at prices and we extrapolate from it. And that doesn't fit into their model of, we want somebody who's going to show us how they have an information advantage, why this is valuable in my portfolio. And so one of the things that actually, I was listening to, Niels, to your podcast with Graham Robertson at Man AHL. Yep. And when I was in London, I asked to see him because I said, there's something, you said something in it that I found really, really interesting, which was, basically that, CTAs, basically the market got it right. The CTAs got the market right. And we ended up having this conversation where I said, look, I think I know that people focus on trend following, but that doesn't land with most investors. Because and Nick Baltus and I talked about this, he brought this up on the year-end thing, which was basically, it's not that people can't see the benefits, it's they feel it shouldn't work because past prices are not supposed to be indicative of future performance. It's not supposed to work in the same way. So what I think is that I think the focus on following prices misses the point for most investors, which is that what is it the prices are telling you? The prices are telling you that information is changing. The market's view on things are changing. And so when we talk about why the CTAs are positioned the way they are, think about what the experience is of a typical allocator. You make the very best decision you can today across your portfolio based upon all the information you have. 6 months from now, everything's going to look wrong. Whatever you thought Apple stock was worth 6 months ago, it's going to be 20% above, 20% below. It's going to be all over the place. Asset classes don't move in lockstep the way asset allocators would like, where you take a little bit more volatility, you got a little bit more return, etc. It's very, very unpredictable. And the unpredictability is based upon changes in information, because the world will be different in 6 months. We start off talking about, the guys who are coming into US and this whole political and geopolitical backdrop. Things are going to be very different, unexpected in 6 months, and that's going to flow through markets. So to me, the value and the semantic shift around it, which is not original, but I think it's something I've come back around to, is basically the way we can get an allocator to think about this in their portfolio is that the reason you analyze prices is to essentially extract information in the markets. As the information is changing, there are certain unconstrained investors, a Stan Druckenmiller in early 2021, who makes an inflation call. He's more flexible and he can see things coming. And so when you start to see things move, like interest rates move, CTAs will pick up, but it's the information they're picking up on. And that information is very, very valuable, particularly at inflection points. Because the great weakness of every institutional allocator is they're slow by design. Even when the house is on fire, they're not going to leave until it is absolutely certain that the house is going to burn down. And so there is something in this, and I will continue talking to everybody in this space about it, but I think there's something jarring about it. And so I think the more we can get people comfortable with the idea that the alpha here makes sense, it's based upon information advantages and taking contrarian trades, the more the language lines up with what a typical multi-asset or hedge fund allocator is looking for, the easier it is for them to get comfortable holding this through periods. Because I look at 2024 and I look at this space as having gotten the information change right early. Dialed into equities early in the year. We hadn't been long equities in a long time. First quarter, we're dialing into long equities. We're dialing into basically for most of the year had bets that rates would remain higher than people expected. This wasn't going to be the year of the bond, as people thought, right? So though the changes in information were correct, what hurt the space, I think, was the whipsaws in sentiment. That yes, the world was changing and the CTAs got it correctly, but people really believed it for a few months and then went completely in the opposite direction for a few months and then kind of so the sentiment was very unstable, but the underlying change in information they got right. So I think if we can just pivot the narrative a little bit into language that people are more comfortable with, it'll be easier to get people to view this as a strategic allocation, something that should be in their portfolio today, 5 years and 10 years, irrespective of those short-term moves in performance.
Yeah, no, I mean, I know you're good at narrative, so I wouldn't.
All I'm good at.
I wouldn't doubt that you're right, and of course, it's part of what have been a constant theme in the last 10 years of the podcast, and actually throughout my career, is the fact that, how can we better explain this industry? And it's not because we haven't tried a few different things, but the information part is new, so that's an interesting thing.
I'm glad you think it too. I wasn't sure if it was new or not. But it's Rob. I had dinner with Rob Carver in London as well, and I was bouncing it off him, and he talked about a lot of academic references to information and slow adoption of information. I think maybe the twist is, frame it in the context of the alpha in the space it's not man-HL against AQR, against aspect, against linked. It's not alpha in the space is not zero sum. This space is trading against every slow-moving investor out there. And every slow mover investor, if they look at themselves in the mirror, they say, you know what, as human beings, we really shouldn't try to be tactical with our portfolios. And so what managed futures then becomes is a completion strategy for a broad multi-asset portfolio. That then allows you to pull it out of the hedge fund bucket into a standalone allocation. And then you can make the argument that, hey, out of your $100 that you have invested, maybe 3% should be in this. Not 20% because of the issue that Tom raises, that at some point everyone's going to hate you because the S&P is going up and this is not. But enough so that in a year like 2022, when the other 97% of your portfolio is going down at the same time, you have this beacon of green you can point to, something you can point to, because the diversification argument that managed futures funds use about more and more instruments also applies to asset classes. 20, 30, 40 individual asset classes. This should be one of them.
You're very quiet, Tom, but nodding along the way. Any thoughts on this before we...
No, you'll find no complaints from me. I think Andrew raises a lot of very good points for the industry. And it's just getting that understanding and the interest in the industry and in the strategy, which is going to be the thing that helps the growth, from 350 billion to the 400 mark.
Sure.
Trillion.
Well, there might be one other factor that's going to get to the 400 billion. It starts with a B and it has a color black, and then there's a rock at the end of it. Andrew, you brought this up. What's going on with BlackRock?
Okay, so BlackRock filed a prospectus to launch an actively managed futures ETF in the U.S. As happens when people launch prospectuses. Or prospecti, I'm not sure what the plural is. There's a lot of missing elements of it, and there's a lot of boilerplate language. But I think this is, I think in my email to you, I said the Death Star cometh, right? So BlackRock is different from almost anybody else who could come into this space, in that they are not just asset managers, but they are also opinion leaders as it relates to the structure and configuration of model portfolios at particularly the wealth management space, but also in the institutional space as well. And so a lot of what BlackRock understands is that if something becomes a strategic allocation, private credit, private equity, etc., it doesn't go from 0 to 5. It goes from 0 to 100 to 500. Because you get trillions and trillions of dollars of pools of capital start to move in that direction. In the US ETF world, there's $12 trillion of capital right now, of which the entire managed future space is maybe $2.5 billion. So this is either incredibly good for the managed futures ETF world, in that if BlackRock comes in, it validates the space, and BlackRock controls not only zillions of dollars of their own models. So if they start putting in this fund in their own models, the AUMs are going to spike. It's going to make our growth look like child's play. But also, they also control the software called Aladdin that many wealth managers use to determine their own asset allocation models. And people rely on BlackRock to tell them what a diversified portfolio should look like. So if this signals that BlackRock has made a decision that when they do that analysis, that managed futures as a category should be a 2 or 3% allocation, you start to see true, what I'd call kind of institutional type adoption across the wealth management space. Now, the wild cards that we don't know are how they're going to price it, whether they're going to be any good at it, whether this is just kind of putting their toe into the water to make sure that we don't know. There are a lot of things that we don't know at this point. What's interesting is that the PMs of this are not managed futures people. One PM is, I think, they're head of quantitative fixed income strategies. Another is a head of their quantitative equity strategies. And they both come, looks like, from the old BGI, Barclays Global's investors business. And I think they're based in San Francisco. So how this all plays out, I don't know, but it's either phenomenally good news for growing the pie, whether they then also make a push to try to take assets from hedge fund investors for the hedge fund. I don't know, but it's big news one way or the other.
You had some big news yourself, actually, just to round things off about another index, or maybe not another index.
So when we first started to replicate the managed future space back in November 2015, we did it for a mandate that we had for a UCITS fund. And so the strange thing about replication is because you're only making these short 1-week bets, it's actually not that sensitive to what instruments you use, because you're essentially making a short-term correlation bet on the market. So when we first did it in the context of a UCITS fund, it was very, very difficult to get exposure to commodities. So we basically said, all right, let's see if we can replicate the managed future space, but without commodities. Where this has become interesting, so we now have a 9-year track record of having done that in the context, but it's in the context of this fund. It's not a standalone product. What I've seen in my travels is that you get very, very, very different preference functions among investors. And there are certain investors, probably more so in Europe than here, who just don't like investing in commodities, but really want to more ways of getting diversification. So within the context of their own constraints. So on one of my trips to Europe, I met with some investors who it's very difficult for them to invest in commodities. And I basically said, well, maybe we have an answer for you. If you like the space and you want to get similar kinds of returns over time, but without exposure to commodities, we have a way of doing that. And so we've been working with Tom and his colleagues at SocGen basically to bring out a non-commodity replication-based index. And so the idea is, and I think Tom in his in an investor survey for this came out a couple of months ago, around a quarter of European investors are looking for things that are ESG sensitive. So can you build a product that allows an ESG sensitive investor or somebody who's restricted on commodities to get exposure to the space? It's very hard to do that in traditional trend following, because as we talked about, when you start kicking out asset classes in a traditional trend following model, you really do lose something. But if you can do it with replication, then start with an index, talk to people at the index, and then maybe SocGen can provide exposure to this index in that fashion. So anyway, it's all about just trying to understand different investors and whether we can build things for them that meet different criteria.
And Andrew, will you be substituting the commodity exposure for something else which you think has maybe a high correlation or similar performance characteristics, or will you just simply be excluding? Because it's something we see a lot of in the European investor base, this inability to touch commodities for various kind of constraints. And it's really divisive when it comes to the hedge fund or the alternative UCITS space because there are various structuring solutions, and SG is like a leading Europe bank, and we continue to push that innovation with ways of structuring exposure to these kind of asset classes via structured notes, where there is demand for it. working with US and European groups. But on the investor side, it's definitely splitting the consensus of the UCITS kind of ESMA guidelines, and the way that the regulatory is interpreted is there shouldn't be any exposure to commodities. And then some of them fall down the line of, well, I really want to have the best product that has as many asset classes in it and has those diversification benefits that commodities bring. And therefore, they're happy to have the structuring solution, which allows them to have the commodities sort of source added to the portfolio via a different source. And so are you going to be hopefully replicating it in a different form, or are you simply going to be excluding it?
So what we do is we add the Australian dollar and Canadian dollar. So we're in currency
as
land,
proxies.
but as proxies.
Yeah.
It's imperfect. It doesn't work quite as well. So if the replication model over long periods of time outperforms the hedge fund index by 350 basis points, this will outperform by 250 of 300. The standard replication model with gold and oil has a correlation of 0.9, this will have a correlation of 0.8. But again, as you say, product structuring is alive and well. It is entirely possible we'll show up to people and they say, oh, we already solved it because, somebody came up with some incredibly clever solution. This is just pretty straightforward. And I think, again, relatively simple and elegant way to get to it. It may not be the only solution, but look, what it does, for instance, is it creates the possibility, if you manage the collateral in an ESG-compliant way, or you do a portable alpha overlay, or it opens up a lot of things, because if you're doing it with 10 futures contracts that are easy to trade, it's structurally extremely efficient, and extremely flexible. So we'll see. We've seen some indications of demand from a limited pool of investors. We're going to work really hard to come back to them with ideas that they think are attractive. We'll see how they respond, and we'll adapt.
Yeah, I don't want to, because I'm going to open up a whole new topic here, which we could talk about for hours, Niels. But on the ESG side, I think it's really interesting. There's no CTA that really exists at the moment that has that quote unquote kind of ESG stamp, and that is an SFDR Article 8, Article 9 sort of certified fund. And I think that's the interesting challenge for the industry in Europe is, can someone think of a way legitimately that fulfills those requirements? Because at the moment, it's really something which is hard to do. The first kind of ESG version 1 per se was to have that exclusion of bad stocks if you're thinking about a simple equity portfolio. But it's very hard to translate that to futures. Futures being a zero-sum game. For every long, there is a short that offsets it. So can you be short commodities if you have a negative view on them, but then there's still going to be the open interest on the long side? And is your objective to price the use of, let's say, carbon emitting things out of the market, or to reduce them so that no one wants to produce them? And so the big challenge has been the way derivatives are viewed from an ESG kind of metric or lens is very unclear, and everyone seems to have different opinions on that.
I'm sure we're going to come back to this topic. It's an interesting idea, replicating commodities without trading commodities. I find an interesting challenge, but for time constraint purposes, we will wrap it up today for this. I will say one interesting little anecdote in this commodity discussion. I was actually looking at historical contributions by market for each sector that we trade, and looking at it over, say, rolling 18 years, 10 years, 5 years, 3 years, 1 year data. And there were 2 sectors where the average performance for each market was positive throughout all the different rolling time periods.
Right.
One was grains, the other one was softs. So just to throw it in and say, commodities can be quite useful and very important in a CTA portfolio.
Well, that's sort of my point, right? Is it's very, very hard to solve, right? What Tom is saying is that we have no idea the demand.
Well, I think the demand is there if you can deliver it.
It's the unification of the demand into a alignment of what everyone can then have
And I
at the
think
same
you only
time.
need to go to one country, Andrew. This is a secret marketing tip. Just go to Germany.
So Germany is weird though, right? Because I've talked to people in Germany, and Germany, you can't do with agricultural commodities because they don't want you betting on foodstuffs, but they're fine with gold, oil, and everything else. So the reason I'm saying we think that there is huge untapped potential, but you don't really know until, like, if you go to an average investor and say, if I could give you Man AHL's Evolution Fund, but in an Article 9 wrapper, right? Everyone's gonna say, yes, of course, right? Of course, I'll take that. Now, it's not practical and realistic. You're not going to find out what they really think until you're standing in front of them and saying, okay, here we are with something you can actually invest in today, and would you like it? So that's the fun of this, though, right? I mean, this is the fun. The fun of it is sitting in front of investors and finding out, like when I talk to people about our ETF in the U.S., and they start off the conversation and say, well, what are you looking for? Something with low correlation to stocks and bonds. It'll do well in a crisis. It generates a lot of alpha. It's in an ETF and reasonably low fees. My conversation with leaders say, well, why would you not invest? That's, to me, a more interesting question. And what is it? And that's when it comes down to the narrative. It comes down to how do I explain it to my client sitting across the kitchen table. And so we'll find out over the next, however long period of time, as we get more specific, and hopefully we'll be able to refine it in a way where a lot of investors will breathe a sigh of relief when they hear about it. And again, for me, I'd rather focus on areas where we can, strategically expand the pie by bringing a product that is very, very, that you can't deliver under normal circumstances. That's a much better use of my time than trying to shake, some guy who's been invested in hedge funds for 20 years and, have him give a quarter of his allocation to us. God, why would I spend time doing that?
Absolutely. Super interesting conversation. I really appreciate both of you for coming on. And I think it's a great way to kick off another year with such a deep dive, but also quite broad conversation and analysis, really, of the CTA space and where we are. And as I said in the beginning, I think it is also at a very critical time, actually, for our industry. So I really appreciate that. Hopefully we can do this again later in the year with both of you on. It's a great dynamic. And if anyone out there listening feels the same way as I do about these conversations, and certainly the inputs from Andrew and Tom today, why don't you head over to your favorite podcast platform, leave a rating and review to show your appreciation for all the information that they provided today. Next week, I'll be joined by Jim. He will be back with, I'm sure, some interesting predictions maybe for the coming year. He was very right about 2024. So that'll be interesting. And if you have any questions for him, you can email them to me, info@toptradersunblocked.com, and I'll do my best to bring them up next week. From Andrew, Tom, and me, thanks so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.